I'm staring at the silver chart, and no exaggeration, this is the moment where markets stop acting like markets and start acting like a crowd. You know those videos where a calm street suddenly turns into a sprint because someone yells, "Go"? That's what a vertical move is. And if you're sitting there thinking, okay, but how can a metal move like this? That's exactly why we need to talk right now. Because when silver goes vertical, it's never just one thing. It's always a stack of forces, and the stack just lit on fire. Quick disclaimer, this is education and commentary, not financial advice. I'm not telling you to buy, sell, or hold anything. I'm explaining mechanics, risk, and context, so you can understand what you're watching. The headline is simple. Silver is acting like $100 is days away. Not because I'm predicting the future, because the tape, the actual price behavior, is behaving like a market that's trying to reach the next round number magnet before anyone can breathe. The vertical context. What just happened in plain English? A normal rally is a staircase, up, pause, pull back, up again. A squeeze is an elevator, up, 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 and the door doesn't open until someone's margin account taps out. Silver didn't politely break $90. It sliced through it. And when a market slices a level everyone was watching, it's telling you something brutal. The sellers at that level are gone. Now you're in the part of the move where buyers aren't debating, is it cheap? They're debating, can I get any? And that's why the price starts jumping in chunks. On some feeds, you'll see prints around $92. On others, you'll see an intraday high in the low to mid 93s. Spot and futures can show slightly different numbers, and every quote vendor has their own timestamp. But the point is not the exact penny. The point is velocity. You don't get this kind of velocity when sellers feel comfortable. You get it when liquidity dries up and the market has to climb to the next place where supply might exist. Gapping without the mythology. People say there were no trades in between. Technically, trades are always happening, but here's what they mean, and it matters. When big orders hit a thin order book, price can jump because there isn't enough size sitting at each price level. So the buyer sweeps the offers, taking everything available, until the next pocket of liquidity appears. It looks like a gap. It feels like a gap. It's basically a gap. And that's your first clue that this isn't mostly retail FOMO. This is the market being shoved by large orders in a place where the shelf is empty. So what's powering it? Two engines. One, the macro bid, people wanting hard assets. Two, the mechanical bid, forced buying from the short side. If you understand those two engines, the last hour makes sense. Engine 1, the mechanical bid, short covering, and the Comex feedback loop. Let's be adult about this. Futures markets have shorts. Always. Shorts can be hedgers, shorts can be banks, shorts can be funds, shorts can be producers, shorts can be market makers providing liquidity. Shorting isn't automatically crime, it's part of the structure. But leverage has a weakness. It turns time into a weapon. When price rises fast, leverage shorts get hit with a double punch. Punch 1, mark-to-market losses. Punch 2, rising margin requirements and tighter risk limits. At a certain point, the short position stops being a view and becomes a liability that has to be reduced immediately. So the short buys back contracts. That buyback is demand created by survival, not optimism. And when survival demand shows up in a rising market, it creates a self-feeding loop. Price rises, shorts lose more, shorts cover, covering pushes price higher, repeat. That's why squeezes feel like they have a motor. And silver is one of the worst places to be on the wrong side of a motor because it's a relatively small market compared to global pools of capital. When a big player needs to move, the market can't politely absorb it. The market has to reprice. Engine 2, the macro bid, why people want stateless money. Here's the uncomfortable truth about the modern world. A lot of your wealth is just numbers inside systems. Systems have rules. Rules can change. And the confidence in those rules is what keeps the whole thing smooth. So when confidence in the rules gets shaken by politics, by war, by legal shocks, money doesn't ask permission. It migrates. It migrates into whatever feels outside the immediate blast radius. That's why you see gold at record highs. That's why you see silver acting like it's on leverage. That's why safe haven isn't a meme. It's a behavior pattern. Let's go deeper on why silver reacts so violently compared to gold. Gold is mostly held. Silver is held and consumed. That single difference changes everything. When demand hits gold, much of it is investment demand, people buying and storing. When demand hits silver, you have investment demand competing with industrial demand, solar, electronics, data centers, medical applications, electrification, and thousands of small use cases that add up. And the industrial buyers don't care about your price target, they care about supply continuity. If you're a manufacturer and you need silver in your process, you can't wait for a dip the way a speculator can. You hedge, you lock supply, you pay the premium, you keep the line running. That's why silver can feel scarce, in investable form during a panic. A lot of silver exists in the world, But not all of it is available to buy at a moment's notice. So when the macro bid shows up and the short squeeze shows up, silver becomes a narrow doorway. And narrow doorways create stampedes. That's why vertical moves tend to cluster with supply stories, even if the numbers are debated. The story is always some version of, I don't want paper exposure, I want the thing. When that story spreads, leverage gets squeezed, and the chart starts printing candles that look like skyscrapers. Okay, back to the smoking guns, now with more clarity and less noise. Smoking gun 1 isn't Powell is guilty or Powell is innocent. That's not the point, and it's not our job. The point is that the chair of the Federal Reserve publicly described subpoenas and a threat of indictment, and framed it as pressure on monetary policy independence. Markets do not wait for a verdict to price a risk. They price the possibility that the institution is weakened, and weakening institutions is the exact environment where hard assets outperform paper promises. Here's how you can explain this to a friend who doesn't care about finance. If the person who controls the money is suddenly fighting for their job in court, the money feels less neutral. That's it. Neutrality is the hidden superpower of reserve currency systems. When neutrality is questioned, the world hedges. Smoking gun 2. Iran isn't just an Iran story, it's a volatility template. Because if unrest escalates, the ripple effects hit global energy expectations, shipping insurance, and geopolitical alignment. And the market hates two things, uncertainty and uncertainty with deadlines. When headlines suggest escalation could happen fast, money moves fast. That's why you see safety bids accelerate into metals. Smoking gun 3. Gold at record highs is the permission slip for silver. People forget this. Silver can be hated for years, silver can be ignored, silver can be called too volatile, then gold breaks out, and suddenly silver is allowed to run because the macro narrative is already accepted. Gold is the judge. Silver is the jury that starts screaming. Now I want to add one more layer, the psychology of $100. Why does $100 act like a magnet? Because human brains love thresholds. Under $100, silver is still a two-digit metal. Over $100, it becomes triple digits. Triple digits changes how? News anchors talk, family members ask questions, fund managers justify allocations, algorithms hunt stop liquidity. It's not rational, it's human, and markets are built out of humans, and human-designed algorithms that copy human behavior. But isn't this overbought? The right answer. Overbought is not a timing tool. Overbought is a risk label. Overbought says, if you enter here with leverage, you can get wrecked by normal pullbacks. It does not say price must crash immediately. A squeeze can stay overbought while it climbs because forced buying doesn't care about your oscillator. So here's the cleanest way to think about the next move. We have two possible paths. Path A, continuation. Price holds above $90, consolidates briefly, then pushes toward the fib zone and $100. Pullbacks are shallow and get bought quickly. Volume stays elevated. Path B, flush. Price spikes, then gets hit by a margin shock, profit taking, or a dollar bounce. It drops hard, fast, and emotionally. Weak hands puke. Then the market either stabilizes and rebuilds, or it breaks trend. Your job is not to guess which path in advance. Your job is to recognize which path is happening in real time. Okay, now let's stitch it together again, but with the full stack. The chart is vertical because 1. Mechanical short covering is forcing buying. 2. The Fed headline is shaking institutional trust. 3. Iran's unrest is lifting the global risk premium. 4. Gold is validating the hard asset regime. 5. $100 is acting like a magnet because humans and algorithms love thresholds. 6. Silver is a narrow doorway because it's both monetary and industrial. That's a lot of fuel. And when you stack fuel, you don't get a gentle campfire, you get a rocket. Now we get to the 3 smoking guns. These are the 3 why now catalysts that turn a metal from slow-moving to explosive. Let's go one by one. Smoking gun 1. The Federal Reserve is being dragged into a political fight. This is the one the mainstream will try to downplay because it's uncomfortable. In the last few days, multiple outlets have reported that the Justice Department opened an investigation into Fed Chair Jerome Powell tied to a renovation project, and Powell himself put out a statement saying the DOJ served grand jury subpoenas, threatening a criminal indictment related to his Senate testimony and that renovation. Read that again. Grand jury subpoenas, threatening a criminal indictment, the chair of the central bank. Powell also framed it as more than a building dispute. He described it as pressure related to interest rate policy and the Fed's ability to set rates based on evidence rather than intimidation. Whether you believe him or not, markets react to perception. And the perception is this: if the Fed looks politically vulnerable, the dollar looks politically vulnerable. Now, I'm not saying the dollar dies. The dollar can be strong and still be distrusted. Those are different things. But if investors sense that the Fed's independence is being compromised, even slightly, then the dollar's credibility premium starts to leak. And when credibility leaks, hard assets catch it. Because gold and silver don't need a committee meeting to exist. They don't need a vote. They don't need an announcement. They're boring in the best possible way. They don't care who's in office. So here's the soundbite that makes the market logic simple. When the referee is under attack, players stop trusting the game. They buy the assets that survive the game being questioned. And notice how this lines up with the price action. This is not the slow, polite inflation hedge trade. This is the credibility shock trade. That trade moves fast because trust can evaporate fast. Smoking gun 2. Iran unrest is feeding the global risk premium. Over the last couple of weeks, we've seen major coverage describing widespread protests and lethal crackdowns in Iran, along with periodic internet restrictions that make real-time verification messy. And then, as the unrest intensified, Reuters reported Iran warning neighboring countries that host U.S. troops that it would strike American bases if Washington intervenes. This matters because markets don't only price what's happening, they price what could happen. And in geopolitics, the could-happen list expands quickly. Energy supply risks, shipping insurance spikes, sanctions escalations, cyber risks, retaliation risks, regional spillover. Now, if you're a big Western investor, what do you do with that? You reduce exposure to things that depend on smooth functioning, high multiple equities, long-duration bonds, assets that assume calm, and you rotate into assets that hold up when calm fails. That's why gold gets the first wave. But silver has a twist. It's both money and industry. It's a monetary metal that also gets consumed. So when fear rises, silver doesn't just get bought as an idea. It gets bought as a thing with real-world demand that doesn't disappear when the news gets ugly. And yes, people love to say stocks are risky, metals are safe. That's too simple. The real point is counterparty risk. Silver in your possession has no counterparty. A promise, a contract, a balance sheet entry, those all have counterparties. In chaos, markets pay up for no counterparty. So while the mainstream argues about politics, the market does its own quiet translation. Global chaos increases the demand for assets outside the permissioned system. 8.10. Smoking gun. 3. Gold at record highs is forcing the silver to gold story. Gold has been trading around the mid-4600s record territory. Now in the real world, people compare gold and silver by a simple ratio. Gold price divided by silver price. That ratio is not fixed. It swings a lot. But historically, when the world is calm, the ratio tends to be higher. When the world gets scared and hard assets become a theme, the ratio often compresses, meaning silver catches up. Here's the logic. If gold is screaming monetary stress, silver becomes the high beta version of that message. Silver is gold on leverage, not because it's a meme, but because it's smaller, more volatile, and more sensitive to flows. Now let's put numbers to it because math cuts through emotion. If gold is around $4,630 and silver is around 92s, the ratio is roughly 50. If the ratio compresses to 45, silver would be about 103Ds. If it compresses to 40, silver would be about 116Ds. If it compresses to 35, silver would be about $132. Notice what that means. $100 isn't a fantasy number. It's what you get with a pretty mild ratio compression in a gold-led regime. That's why traders see air between the low 90s and $100. Not because resistance is impossible, but because the story that would justify $100 already exists on the gold chart. Now let's talk technicals, because yes, the charts are confirming the vertical move. But I want to do this in a way that doesn't feel like astrology. Technicals are not magic. Technicals are a language describing human behavior around price. Technical 1, RSI over 80. RSI over 80 is extremely overbought. In normal markets, that's where people start taking profits. But in a short squeeze, RSI becomes more like a siren than a ceiling. Why? Because RSI measures speed. Squeezes are speed. In a squeeze, overbought can stay overbought for days or even weeks while price keeps climbing, because forced buying keeps the momentum alive. So RSI doesn't tell you it must drop. RSI tells you the move is violent and the risk of whiplash is high. Technical 2, Fibonacci extensions and the $97-$98 zone. When price breaks out of a base, traders project extensions to estimate where the next liquidity pocket might sit. One common target is the 2.618 extension, and in this structure, it points toward the high 90s, roughly 97.50, give or take. Think of it like this. If the market is sprinting, that's a water station. Does it stop there? Not always. But a lot of algorithms use those projections as reference points for taking profits, placing stops, or initiating hedges. Technical 3, the $100 psychological magnet. Round numbers are not real resistance. They're behavioral magnets. People set sell orders at $100. People set stop orders at $100. Funds that need a headline level wait for $100 to justify their decision. Media waits for $100 because it's simple to say. So price often accelerates toward the round number because everyone is watching it. And then, once it hits, you can get either a breakout continuation or a sharp emotional pullback. Both are possible. Technical 4, volume running multiples of normal. When volume runs 10x to 14x average, the market is not whispering, it is screaming. Participation has changed. This is where the debate begins. Is it late retail, or is it early institutional rotation? The truth is usually both, but in phases. Institutions often start positioning before the masses realize the regime changed. Retail often arrives when the number becomes a headline. We may be in the transition zone where big money is already moving, and the public is just starting to look up. That's when the chart goes vertical. Okay, now comes the part that will save you money if you actually listen. Vertical moves are not free money. They are the highest risk environment in the market because vertical moves do two things at the same time. They reward conviction and they punish impatience. Here's what that looks like in real life. Silver can rip $5 in an hour and then drop $7 in 20 minutes and then rip again. Not because silver is dead, because leverage gets flushed and then the bid returns. So if you're watching this and you feel your emotions spike, good, that means you're human. Just don't let your emotions write checks. The empty air explanation without the hype. When a market spends years trading under a certain zone, there's a lot of memory down there. Memory is people who bought and want to sell at break even, people who shorted and want to cover, people who missed and are waiting, people who got hurt and are cautious. But when the market breaks into a zone it hasn't lived in, there's less memory. Less memory means fewer stacked orders. Fewer stacked orders means thinner liquidity. Thinner liquidity means faster moves. That's what people mean when they say there's air. It doesn't mean the move is guaranteed. It means the map has fewer guardrails. So what should you watch over the next few sessions? I'm going to give you a squeeze survival checklist. Not a prediction list, a checklist, because when you have a checklist, you stop reacting like a victim. Checklist item 1. Are we seeing forced buying or voluntary buying? Forced buying shows up as sharp bursts, thin order books, violent candles, sudden spikes in volume. Voluntary buying shows up as steady accumulation, less chaotic structure, pullbacks getting bought calmly. Right now, this looks more forced than calm. Checklist item 2. Are we getting margin changes? Exchanges can raise margin requirements. Brokers can increase house margin. That's the market saying, this is too hot. When margin rises, leveraged players have to post more collateral. Some can't. They sell. That can cause sudden, scary dips. Those dips can be the start of a top or the shakeout that clears weak hands before another leg higher. You don't need to guess. You watch. Checklist. Item 3. Does gold hold its regime? Silver's catch-up story is strongest when gold stays strong. If gold rolls over hard, silver can still squeeze, but the tailwind weakens. So watch gold's trend. If gold stays bid, silver has a runway. Checklist. Item 4. What is the dollar doing? If the dollar index rips higher and yields rise, metals often get pressure. If the dollar weakens and yields fall, metals breathe. The current setup, fear plus credibility questions, tends to lean toward a softer dollar narrative, but markets can change quickly. Checklist. Item 5. What's happening in the Fed story? This is the big macro trigger. If the narrative becomes the Fed's independence is compromised, hard assets get a credibility bid. If the narrative becomes the investigation fizzled, some hot money will cool. It doesn't mean silver collapses. It means the fuel mix changes. Checklist. Item 6. Physical market signals. This is where things get spicy. If paper price rises and physical premiums rise even faster, that's a sign of tightness. If paper price rises but physical premiums stay calm, the move may be more paper-driven. Neither is good or bad. It just tells you what kind of move you're in. Now let me tell you the story of what's happening in one sentence. Silver is vertical because the market is pricing a credibility shock in the dollar, a volatility shock in geopolitics, and a mechanical shock in short positioning, while gold is already confirming the hard asset regime. That's why $100 feels close. It's not a prophecy. It's the path of least resistance if the current forces keep pushing. And now I'm going to say something that might annoy both the hype crowd and the skeptics. Two things can be true at once. Silver can be in a historic repricing, and silver can still crash hard in the middle of that repricing. Those are not contradictions. That's what volatile assets do when regimes change. So if you're the kind of person who needs a clean, comfortable story, you're in the wrong market. But if you're willing to learn how squeezes behave, this is one of the most educational weeks you'll ever watch. Is this a blow-off top? Let's answer that like a grown-up. A blow-off top usually has these ingredients. 1. Nonstop headlines. 2. Mainstream euphoria. 3. Everybody suddenly knows it can only go up. 4. Volume spikes at the end, not the beginning. 5. Sharp reversal that traps late buyers. A repricing regime looks like 1. Big move starts while most people are skeptical. 2. Pullbacks get bought. 3. Price holds higher levels instead of immediately collapsing. 4. The narrative shifts from crazy to inevitable. Right now we have headlines, but I don't see full mainstream euphoria yet. We're still in the wait, this is real phase. That's usually earlier than people think. The honest risk section, because you need it. If you are trading this, respect volatility, respect position size, respect the fact that silver can move more in a day than most assets move in a month. If you are holding this, understand that drawdowns are part of the ride. This is not a savings account, it's a storm. If you are watching this, don't let the chart bully you into a decision you don't understand. The market's job is to mess with your psychology. Your job is to stay logical. What I think the chart is trying to do. I'm not predicting. I'm reading behavior. Behavior says the market wants to tag $100. It wants that headline. It wants that liquidity. It wants that psychological unlock. Whether it does it tomorrow or next week depends on whether the engines stay on. If the engines stay on, $100 is not far. If the engines sputter, you'll get a violent pullback that scares everyone, and then we reassess. Either way, the story is historic. Because once the public sees silver in triple digits, it changes how everyone talks about money. Quick recap of the 3 smoking guns. Gun 1, Fed independence fear, credibility shock, hard assets bid. Gun 2, Iran unrest, plus escalation risk premium up, no counterparty assets bid. Gun 3, gold at record highs, ratio compression logic, silver catch-up pressure. Stack those 3, then add the mechanical squeeze engine, and you get this chart. Final question for you, and I want a real answer in the comments. Is this a blow-off or a reprice? One word, type it. And if you want me to keep tracking the signals in real time, margin changes, volume, gold's trend, the ratio, the Fed headlines, subscribe, because the next few sessions are the kind of sessions people talk about for years.